listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to another episode of the Daily Gold Podcast. With me here today is a first-time guest. He is Keith Weiner, the founder and CEO of Monetary Metals, and we'll talk about monetary metals in this interview. But first things first, Keith, I want you to talk about how you and the team at Monetary Metals, how you evaluate and you look at gold, because it's a little different than how most people look at it. I think that'll be instructive for the listeners as we start here.
Sure, absolutely, and thanks for having me, Jordan. So I guess a lot of people do technical analysis, looking at price chart, past price performance, to try to predict future price performance. We have something we call the gold fundamental price, which is the calculation, it's the output of a model. And what the model is doing is it's saying, you have the actions of, 7 billion people on this planet, all of whom are potential buyers of gold. And outside the U.S., it's amazing how many people don't really think of their local paper currency as a vehicle for savings at all. If they want savings for the longer term, it's gold. It's not paper currency. And so you have the buying and the sell, and of course they sell also. You have the buying and selling of the people that are, as it were, stackers, that accumulate the physical metal or sometimes decumulate it. And then you have the action of the speculators using big leverage in the futures market. And the speculators, because they have access to big leverage, can certainly move the price around, and price is set at the margin, so they can be the marginal price impact. So we have a model that attempts to calculate if you back their actions out. Sometimes they're bullish, they're pulling the price above where the metal would be clearing. Sometimes they're bearish, and they're pulling the price down below, where it should be. And that's exactly where we're at right now. So we have a market price, around 1900-ish, but we have a fundamental price closer to $2,000, about 1980, 1990. So that's how we come up with our short-term. This is what the price would be. It's not necessarily a prediction that says it's going to happen tomorrow morning or next week, but there's a bias that the market price should be a bit higher.
And so I guess I have two follow-ups to that. I mean, the first would be, tell us more about the model. I mean, I don't want you to give away anything that's proprietary, but can you give us a few more details on that? And then secondly, given that the market price is about 4% below where your model sees it, what does that tell you about, I guess, the short-term outlook or the short-term trend? I mean, how does that compare to when you had a similar reading in the past?
So obviously, each situation is different, but the market price and the model price tend to converge. And if it'll be useful, I can send you a chart, showing let's say back to last December, or pick a time frame, and show how they kind of go back and forth. But they do tend to converge. So the theory for the model is pretty simple, and I've written a lot about the idea of the gold basis. So in really simple terms, basis is future price, that is the price of a futures contract, minus the spot price, which is the price of the actual metal. And that spread between the two, you can look at that as an annualized percentage, so then it becomes comparable to quoting against yield or LIBOR or whatever. That basis is kind of a measure of the supply and demand fundamentals of the market at that moment in time. So I'd like to kind of make this real by giving a very simple example that hopefully people can relate to, and that is, suppose the wheat harvest comes in at the very last bit of July in the northern hemisphere. So let's say you show up in one of those grain elevator towns in the American Midwest, July 24, July 23, like before the harvest has come in, and you come in with a grain truck, and you say, how much to fill this here grain truck with wheat? and they'll laugh at you. I imagine that they have the tops flipped on those silos. People are hosing them out, cleaning up, waiting for the wheat harvest that's going to come in a week. And then everybody's empty at that moment, and you're saying you want to buy wheat. So if you take out a stack of $100 bills, then somebody's going to stop laughing, and he's going to make a phone call and turn around some truck that was, the last truck with the last bit of wheat, headed on its way to a bakery, and turn it around and bring it back. If you're willing to pay, I don't know, I'm just going to make up an arbitrary number, $20 a bushel. Whereas if you were willing to buy a contract for September delivery, you might pay $8 a bushel. So that difference, so that's called backwardation, that the price for spot delivery is higher than the price for future delivery. That's an indication of a serious shortage or scarcity of wheat to the market. And you can see why the days before the harvest comes in, of course, everybody's empty. The whole market, is pretty good at coordinating, and it runs out of wheat just in time for the next harvest to come in. So backwardation means scarcity, and the inverse is also true. That is, if you have a high, so that's a negative spread between futures minus spot. If the spread is in the other direction, if spot is higher than, futures are higher than spot and significantly higher, and especially if it's rising, then that indicates that there's an abundance to the market. So by looking at this spread, the basis spread, that's the basis, no pun intended, of our model, in trying to assess relative scarcity versus abundance of gold to the market.
Okay, very good. So provide us some color on what you see now in the market. I mean, given that the fundamental price is higher than where the market is right now, what's your own personal view or analysis of the current situation in just of the market, the gold market in general, and then taking into context your model?
So if I had to take a guess, and I'm very leery of, it's a classic, CNBC, thing. Stock moves 1%, that day. Journalist finds some dubiously correlated tidbit of news and says, well, this tidbit of news is absolutely the one and only cause of this price move. So being very mindful of that as a potential risk here. If I had to read the tea leaves, I would say that the story that is kind of circulating in more mainstream circles is peak inflation. That we had this huge inflation print, but now the central banks are, getting a handle on it, and therefore, inflation numbers are going to come down. People classically think of gold as an inflation hedge. Therefore, peak inflation should come with peak gold price, and therefore, in the futures market, people that are trading, and this is more of a Wall Street mentality versus the people all around the world that are buying gold for other reasons, would say, okay, well, it's time to sell, maybe even get short, but certainly time to sell their long positions in futures. And so you have a little bit of pessimism in the futures market that is not reflective of what's going on in the spot market. So you have a depressed price as a result of that, but that isn't sustainable because the natural tendency of the physical buyers is going to be an upward force. Again, 3-4%, nothing like super, super huge. If I had to read the tea leaves, that's what I would say right now.
Okay, now one other thing I want to talk to you about, and we didn't cover this before we started recording, but it's something I wanted to ask you, and that's the LME news that we got, I believe, last week. So the London Metal Exchange is ending gold and silver futures trading by July. Right. What is that? Because all these types of pieces of news, gold bugs get super excited and think it means gold's going to go to 5,000, immediately. So right. What's your view on this? Is it significant or not? What's really happening here?
I have to preface this, Jordan, by saying that for many years, there's a lot of things that happen that gold bugs would say, therefore the price is going to go to 5,000 or 50,000. And I was perceived as the wet blanket on the market, the perma bear, and all these things. And so a lot of people, hated me for that. But I think maybe I came to earn a certain degree of respect because the gold bug predictions didn't necessarily come true. And so here I'm again. I realize this has become quite a big meme in the gold community, and I'm about to say it's a nothing burger. So, LME entered the gold futures market in 2017, right? So they're a very recent entrant, and obviously, if you want to come into a market there's already a market operator, and it's already a global market, which is COMEX in New York. And you think you're going to take, you have to take market share from the leader. It's not like you're growing the market. I mean, the demand for gold futures is what it is. So you have to take share from the leader. And the way markets work is everybody's going to favor the market with the greatest liquidity because it has the narrowest bid-ask spread. The bid-ask spread is the loss you take to trade in and out of a position. So narrower spread, you have a very strong, every trader has a strong incentive to find the most liquid market. So they thought they would take market share from the COMEX, both enough market share to have enough liquidity that the spreads would be competitive or better, and also they have to get enough volume. The exchange makes a profit on every trade, but it's a very small profit. It's pennies. You need a lot of trading volume in order to make money. So that was their business plan. That was their hope of what they expected to do. Here we are 5 years later, and they're, evaluating their business plan and realized we're not making any money, we're losing money. If you're losing money after 5 years, you have to give up hope that you ever will make any money. So they said, pull the plug, we're done. I don't think it has anything to do with the futures market as such. It is not a quote-unquote signal failure or anything like that. I think it was a weak second entrant attempting to come into the market, failing to take the market share that they hoped to take. And I have to say, I don't know what market share they could have taken at all. I'm not aware of a single player, and we talked to institutions, we talked to bullion dealers, we talked to a lot of different companies. I'm not aware of anybody that was trading on LME. I know lots and lots of people that trade on COMEX. So I can't imagine that they got even a fraction of the volume that their business plan would have called for them to get. So they pulled the plug and said, let's stop losing money on this and move on. That's my take.
Okay, I like that. Now, you talk about how you have a short-term view and then a long-term view. Let's get into the long-term view. I mean, where do you see the gold market going in the next 3 to 5 years? What are some of the important things that we should be focusing on?
I think the first point, and a lot of people would accuse me of being pedantic in making this point, is that one has to realize that gold is money and everything else is credit. And therefore, one has to price credit in terms of money and not the other way around. I'll use the analogy of suppose you're on the deck of a ship, which is both slowly sinking, that is, there's a small leak, it's slowly sinking, and you also happen to be in a storm where the waves are going up and down, 20 meters. So you're standing on the deck of the ship going up and down and with a downward bias because you're sinking. And you're looking at the lighthouse, which is on the rocks, and you say, why is the lighthouse going, up and down and mostly up? And you can never really understand what the reality is from that vantage point, because you're standing on the ship of that deck and you're not really getting it. But if you were to get in a helicopter and look down from above, you'd realize that lighthouse isn't going anywhere. And that's my view of gold. So people have been accumulating gold for 5,000 years, which means so all normal commodities have. So the concept is marginal utility. How much is the value of the next unit, the nth plus one unit, as a proportion of the nth unit? All commodities have a rapidly falling or diminishing marginal utility, but gold's been accumulated for 5,000 years. Virtually all the gold ever mined in human history is still in somebody's hands, and yet we keep mining more of it, which means that the value of the nth plus 1 ounce of gold is the same as the nth ounce of gold. And therefore, gold can be an objective measure not only of itself, but of everything else. I'm glossing over a lot of the theory here, but to sort of make a point that one should think of the dollar's value in gold terms rather than gold's value in dollar terms. And in that view, you see the price of the price of the dollar, beginning its life, depending on whether you go back to 1913 or 1971, when it was finally set loose and becomes a price and not merely a a unit of measure, at 1,500 milligrams per dollar, and you see that price falling, and here we are, well under 20 milligrams on our way to zero. And the reason why we're on our way to zero is that the dollar being a credit instrument, you have to look at its quality. Which is the dollar is a slice of the U.S. government's debt. Does the U.S. government have the means or intent to ever repay that debt? The answer is obviously not. 20 years ago, you could have argued at least there was a possibility of a plan to tax people and have austerity and so forth. But given, $30+ trillion debt at this point, even that is mechanically not even possible. So who wants to own an unsound credit as it gets closer and closer to some sort of default event? And, instead, would you prefer to own money that is not subject to default? That's the first issue. The second one is we are in a long-term falling interest rate trend. So at the same time that the risk of default is rising, or the imminence of the default is getting closer, the reward for taking on that risk is diminishing as the interest rate falls. And I realize right now we're in the middle of a correction. The interest rate has gone up. People saying calamity, blah, 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 blah. But as that trend reasserts itself, and I think it will do so with a vengeance, as the interest rate you can get to own that dollar goes down and down and down, then the attractiveness of gold increases relative to the attractive holding that dollar.
Right. Now, I want to get your thoughts on silver. And because silver has been considered money historically. I mean, obviously not to the degree that gold has, at least recently. What's your view on silver? And do you have any thoughts on why, just historically, it's just, at least right now, it's under. I mean, not only has it underperformed gold most of the time, but it's also, you look at copper copper recently made an all-time high, but silver's not even close to that. Do you have any views on silver, its monetary characteristics or lack thereof, and why the price is where it is?
Yeah, I think so two things. Obviously, silver has a industrial component to its usage that gold doesn't really have, or to the extent that gold is used in industry, most of that use is recycled. So we can recycle gold out of circuit boards and semiconductors, for example. Silver just isn't worth it. It's just too cheap. So if a washing machine has silver in the switch contacts and that's thrown into a landfill, then that silver is effectively lost. But you make an interesting point. Silver and gold are both money, but they serve slightly different, not just different user groups. You could say, well, gold is for rich people and silver is for less rich people, which is certainly true. Gold is the preferred savings vehicle of the wage earner. So think about, and today is the same as it was thousands of years ago. If you're a skilled worker and you're making a wage, so today that could be, $500 to $1,000 a week, let's say, and you want to put 10% of that wage into gold, into money, whether it's gold or silver, $50 or $100. What does that get you in terms of gold? For gold, that gets you a little flake that you're going to pay a very high premium for that. For silver, it gets you a small handful of it, and the premiums will be a lot lower. So silver is the preferred savings vehicle for the wage earner because it's the more efficient means of savings. So as the economy is, struggling, and I realize that the numbers today paint a very rosy picture of the economy, but underneath it, I think it isn't so rosy. So we have a low unemployment number, but we have 100 million people in the U.S. who aren't counted in the workforce and therefore aren't counted as unemployed. So if you can exclude everybody from the unemployment number, you can say we have a very low unemployment number. But anyways, it's the wage earners that buy silver as their savings vehicle. And as the economy, and I should say the monetary system really squeezes them, which it's been doing for decades, the more it squeezes them, the more that they're not buying silver, whereas gold competes against other capital assets. So people can sell real estate or Bitcoin or stocks or bonds or whatever and gold trades, against those things essentially, then they're going to trade differently. And so we wrote our annual gold outlook report, which we published at the end of January this year. And I said this year the call for gold and silver is the most difficult of any year we've ever had. And that's because the Fed is promising, huge rate hikes. If they persist, those rate hikes are going to, at least be the proximate trigger for an awful lot of pain. But if the Fed persists in that, then that is probably not that bullish for the price of gold and downright bearish for silver. On the other hand, if the Fed reverses course, comes back with their tail between their legs and says, oh yeah, all the rate hikes is off. We don't care about inflation anymore. All we care about is preserving, capital markets and, jobs or whatever it is they come back and say, then that would be bullish for gold and probably even more bullish for silver. So it's kind of a bifurcated risk or binary outcome risk based on the Fed's, coming decision when they're going to back off, which is now attempting not to predict, money and markets, but essentially political outcomes. And we don't claim any particular expertise to know what a politician is going to do.
I wanted to get your views on how many more hikes you think the Fed can get in. I know the market's pricing in about it's near, at least last week they had priced in a 50-50 and a 75-point cut in the next 3 meetings. I mean, any sense of how many more hikes you think they can do?
Well, we're at a point where every time the interest rate is lowered, the marginal productivity of debt falls as well. So think of the minimum wage discussion. There's the wage and the marginal wage. And what the law does, it raises the marginal wage. And people think that raises the wage. No, it just raises the threshold. It raises the bar. And anybody whose work is worth less than that has to be laid off. So the same thing with falling marginal productivity. Every time the interest rate goes down, projects that may or may not have been viable previously now become viable. So imagine you're a hamburger restaurant chain. You have a number of stores around the country. You always have a spreadsheet in your back pocket, which is your business case for building the next marginal store. And the reason why that's called the marginal store is that it's the one you didn't build, waiting for something to change, either the population demographics around that store to go up, or they lower the interest rate. So every time the interest rate goes down, it's an increased incentive for every producer of hamburgers, pizza, and as well as hamburger grilling equipment and everything else. Their business case spreadsheets flip from red to green, and then they build that capacity. And so what that does is it creates an awful lot of debt and an awful lot of very marginal producers. You start to hike the debt, all of that stuff, slams into reverse. All those businesses are going to close their doors, lay off their workers, which is one thing, but default on their debt. I don't think the Fed actually cares about unemployment or inflation. I think their real mission is to enable the government to borrow all that it wants for the vote buying scheme, which is what it really is. And I think they care about the solvency of the big banks. So you start to get closures and defaults. And of course, all those laid off workers begin to default on their home mortgages and their car payments and whatnot. So the question is, how much pain will the Fed sit by and watch while all this is occurring before they jump in and say, no, we're gonna reverse course? I don't really know the answer to how long they're going to wait. I do know that today's Fed, compared to the 2007 to 2008 Fed, is going to be hyper proactive. They're going to be, with their finger on the trigger, with an itchy trigger finger, looking for signs of, stress or crisis or whatever, and jump all over it. And they're not going to be. They would regard today's Fed would regard the 2008 Fed as, lazy, negligent, allowing things that they shouldn't have allowed. Bear Stearns, and then later Lehman Brothers, and a lot of other things. So when will the Fed cry uncle? Anybody's guess is as good as mine, but I have to imagine that uncle moment is coming. They can't continue to push rates up. It isn't going to work.
Okay, now before we close, Keith, can you tell us about Monetary Metals, the work you do there, and how our listeners can follow the work that you do at Monetary Metals?
So our website is monetary-metals.com. We're at Monetary Metals on Twitter. I'm at Real Keith Weiner on Twitter. Monetary Metals, we pay interest on gold in gold. So we have this idea for a bottom-up entrepreneurial free market approach to the gold standard, and that is when anybody who wants to can deposit their gold and earn interest on their gold. So that's what we do, is we pay interest on gold, and we're rapidly growing early-stage business, helping to bring back a more honest monetary system.
Great. So how can listeners, is there a way that they can get in touch with you at Monetary-Metals or someone else so they can learn more about what you do?
Yeah, we have our phone number on the site. There's a, you can click on, you want to contact us and, send in a form with a question or concern or ask to be called or whatever. And we've got a team of relationship managers that will get right back to you.
Okay, great. Keith, thank you so much for coming on. Really enjoyed it, and I hope we can have you back again in the future to discuss your views of the market as things change.
Thanks for having me, Jordan.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.